Equity market capitalization is more concentrated now than it has been in over half a century, creating important implications for investors. I'm Brad Neuman, Alger's Director of Market Strategy. The top 5 companies in the S&P 500 comprise approximately 1/4 of the index. That's much higher than the 14% average since 1990. Within the Russell 1000 Growth Index, the market concentration is even more stark. The top 5 largest companies comprise over 40% of the index, nearly double the 21% average since 1990. A significant driver of this trend is these companies' fundamental success. In the past decade, the top 5 weighted stocks in the S&P 500 have grown their share of earnings more than 30%, from under 12% to over 15%. But that's only part of the story. These large companies today have much better business economics than their cousins of decades past. For example, while AT&T was a top constituent for many decades, it reported only about a 3 to 5% return on assets. In fact, all of the top S&P 500 constituents in 1990 had return on assets of 8% or lower. This pales in comparison to Apple, Microsoft, or Google's return on assets today, which ranges from the teens to the mid-20% range. Generating stronger return on capital may boost valuations and in turn market capitalization related weightings. While fantastic profitability and strong growth are good reasons that a handful of mega-cap stocks dominate equity indices today, the last 50 years of data shows that it's unlikely that concentration will increase much more. Furthermore, the era of companies persistently holding a top position in index weightings for decades like AT&T was able to do is probably behind us. That's because while the profitability and return on capital of companies are higher than ever, the period for which they earn those returns is shrinking. In the late 1970s, companies in the S&P 500 had an average tenure of 30 to 35 years. Today, it's closer to 20 years, and likely to fall in the future in our view. We believe this is because the pace of innovation is accelerating. For example, the speed at which companies can scale up and disrupt industries is increasing. Now, if change is accelerating, it may make new and upcoming companies that can become the leaders of tomorrow even more attractive. Importantly, these small and mid-cap growth companies are historically inexpensive. If some of these companies do go on to challenge the old guard of mega-cap companies in the years to come, it could prove to be quite an opportunity for investors. For more on this topic, please see the recent paper we published entitled, "Are You Concentrating Too Much?" which is available on the Insights page of the Alger.com website. Again, I'm Brad Neuman, Alger's Director of Market Strategy. Thanks for watching.